Welcome back to another BMO. And of course, as you know, we have a lot to go over today. Now, before I get into things, just giving you a sort of brief summary of how this week has come out. We had a bit of GDP data come out for the Eurozone. It hasn't really done much for them. It's more so been, the focus has been on, of course, the Fed. We had Bank of Canada hold rates, but truthfully, this week's all about the Fed. We're going to touch a bit on the Bank of Japan because they held rates, but they did increase their inflation forecast. But there's been three pivotal sort of moves from Wednesday to Friday this week, and it's essentially been the Fed held rates on Wednesday, and in the press conference, Powell essentially acknowledged that they are seeing slight inflationary pressures from tariffs. However, he doesn't expect them to be long-lived. Then what happened from there is that the PCE came out relatively inflationary, 0.3% as expected. It really didn't move the market too much. And today is really going to be the definitive factor for the US dollar and for the future, basically, of Powell's policy direction in the immediate term. Now, why is this week being so pivotal? Well, it's simple. We will get into this in the dollar. We have seen one thing that has driven the markets from left to right, and it's been a huge repricing with regards to how many cuts we get this year from the Fed. We will touch more on that in the dollar, but that's what's led to such a strong leg in the dollar and an unwinding of dollar shorts, basically. But as always, how do I put this? Very coincidentally, at the month end flows, right? So we'll see how pricing continues moving forward from there. Now, as I said, if you're looking at this week, we've had a fair bit of growth data from the Eurozone. Germany flashing some real economic fears really on a quarterly negative, but Europe on a whole up on the annual and quarterly coming in at consensus. We did see a huge advanced GDP print from the US, showing a big bounce back in Q2 from them. Arguably, this could be stockpiling of goods basically prior to tariffs taking effect. One interesting stat I read about this was actually the personal private consumption regarding consumers. And by the way, consumption in the US makes up 75% of the GDP. Personal private consumption is down over 70-something% since last year, which means consumers are consuming at a drastically slower rate. Now, we did see a bit of negative PMIs on the manufacturing front from China, with the BOJ holding rates, but increasing their inflation forecast, which we will look at. Consumers are remaining relatively confident, not as confident as we want to see them. We want that above and beyond 50, of course. Inflation at target for Germany, PCE coming in as basically a non-mover, really. The real pricing is going to come in today, and that's going to come in from your unemployment rate, from your NFP, of which I will be looking at a few levels on the fixed income side of the coin to show you guys and girls, what I'm thinking. And of course, can't ignore the inflation at target for the Eurozone. So if we just go down the severity, just before we go any further, still increased borrowing in the UK at the minute, which is crazy given the rates. We did see the inflation on a quarterly basis ease in Australia, the monthly CPI coming in at 1.9%, which is below basically the target. More importantly, it's the trimmed mean CPI that we care about, and that did slip to 0.6 on a quarterly basis, 2.7 on an annualized basis. So it is still elevated on an annualized rate when, of course, the RBA are looking at that. However, it is the quarterly that they look at. Another interesting print that I did pick up on, if we just scroll down, is this bounce back in retail sales month over month from Australia. It could be just, it could be numerous different things. It could be a seasonality point of view, which I don't think it is. But it's just interesting to see that consumption is still relatively firm in Australia, but that's just a monthly print. This, we have a lot to go over with the BOJ. Unemployment rate in Germany remained at 6.3%. It's pretty elevated. Same thing with Eurozone, and inflation coming in at target, as I said. So yeah, really speaking, that's what we've had this week. It's NFP that's going to be the huge driver, and I'm going to very, very soon jump into why that's the case. But if you haven't already realized, essentially this week has been the week of repricing rates, and that is going to be basically the topic of discussion in today's breakdown. So yeah, that is me on the breakdown. Unless you have anything, or the introduction, sorry, unless you have anything to add, Mark?
No, nothing else to add on to that.
Perfect, let's jump into the dollar. Okay, so what happened this week with the dollar? So the first thing to start off with, and first thing that's easiest to understand actually, is Powell. Now, what Powell had said, and I'm going to pull up ING, yesterday's document. What Powell said essentially was considered, and I don't disagree, on the hawkish side of it. Okay. Now, he reiterated expectations for a short-lived inflationary impact and on tariffs, and said a modestly restrictive policy was appropriate. So basically what he said is, I expect prices to rise soon, short term. I'm going to keep policy modestly restrictive to combat that. Now, on top of that, just before I go any further into this article, for those of you that have time on the weekend, go and research General Motors. Go and research, there's a few others, Procter & Gamble. Go and research these companies that have released their earnings and look at their CFOs and the statements they've made. A lot of the companies in the US right now are literally saying in their statements, we are going to cost push at least 30% of the increase or the margin we're losing due to tariff revenues. So this is what Powell's saying here. He's saying, I think we're going to get short-term or short-lived inflation impact. And this is why I'm keeping policy modestly restrictive. He seemed to put himself on a collision course with Trump by claiming the Fed was looking through inflation by not hiking. So what he's saying here, excuse me, a bit of a sore throat today. So what he's saying here is, Trump, you're lucky I'm not increasing rates due to your absolute clownery. You're lucky I'm not taking rates higher because you're going to drive inflation higher. He said he is looking through the inflation by not hiking, keeping rates where they are. Now, what's happened is the front-end treasuries have sold off, meaning the yields have risen because the price of the bond sold off. And now the market pricing for September has fallen. Now, this was yesterday's pricing, 42% probable for a one cut this year in December. Let's see what it currently is today. So that's 41. So bear in mind, it was only literally a week ago, the market was 42% sure we were going to get two cuts. Now the market's 41% sure we're going to get one cut. So do you see how the market is now pricing out one interest rate cut this year? Meaning they're pricing in less cuts. And that is why the dollar is catching a bid, because we have overpriced the cuts into the monetary policy. We have overpriced the pessimism into the monetary policy. And when you couple that with the fact that GDP is bouncing back, earnings are blitzing it. Microsoft are valued at 4 trillion, the second company in history at 4 trillion, just behind NVIDIA. Facebook or Meta's earnings are seriously good. You're seeing the earnings season is actually surprisingly holding up well for now before tariffs kick in. And what you're seeing there then is the strong GDP. You're seeing all this data come together to basically give the US a bit of a, all right then, mate, we'll unwind a bit of that pessimism for now. However, the minute we start to see cracks show further, i.e. the actual true effects of tariffs, the true effects of rates remaining too high for too long, etc., the more you're going to see the market, in my opinion, turn back negative short of bottom. Okay. Now, they go on to say, whilst tempting, we are not calling for the end of this dollar run just yet, primarily because of the PCE and tomorrow's job figures. It can lead to hawkish repricing of the dollar curve. Now, whilst we're speaking about the dollar curve, let me just explain what I mean here. In fact, I have what is the chart I'm going to need to pull up quickly. Give me one sec, guys and girls. I'm just searching for it in my chat here. It is, oh, it's going to annoy me. It's going to annoy me. It's going to annoy me. It is US dollar. Did I go? Essentially, what I was looking for here is what you may start to see in the immediate term is more of a, correct me if I'm wrong, Mark, a bear flattener occur where you may see the twos rise at yields. This is rise at a faster rate than the tens as the market basically moves towards more of a, is that correct, Mark?
You are correct, sir.
Perfect. As the market moves more towards a repricing mode, I wouldn't even say it's a view of long-term growth mode. It's just the market putting rates back into the US. Now, interestingly, today we've actually got the inverse happening. Twos are falling faster than tens today. However, one thing I will say, just speaking about the curve that we're discussing right now, is that if we see today something like this, this will give your dollar a short-term boost of energy. However, you have to understand, guys and girls, right now, the US policy, as it stands, is here. This is where interest rates are in the US right now. Oh, it is here, okay? This 4.25 to 4.5 is the current interest rates. So in order for the market to push yields up into this region, what the market would have to be saying essentially is we see no cuts this year. That's what the market would have to say. Hence why the 4% mark is huge for the 2-year yields, because this is the market saying to you, we are still in this region pricing in one reduction on a 2-year basis or in a monetary policy. Now, this is why the 4% mark is going to act as a ceiling. My best case scenario is we either reject here, and this will mark a bit of a low in the dollars temporarily, or you see people trying to short at that 4% level, and we trade a bit like 4.04, 4.05. And in actual fact, what we then see is a lot of people getting caught offside with regards to the US dollar, and then we see reversals coming in because we closed above 4%. They start to get even more optimistic, blah, 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 blah. Now, on that note, what I would say is this is the level that the price is going to be catalyzed towards. Same with the tens. If we get really good employment data and the market moves to pricing in one cut, you may see the tens move towards 4.5, but that is a ceiling in my opinion. So this is what they're saying here, is that it can lead to even hawkish repricing on the dollar curve. And we could see a bit, in my opinion, we could see a bit of a bear steepener occur. Okay. Now, what I will say is today's ING is a different story. Now, if you haven't been paying attention, there's a reason my throat's a bit sore today. And there's a reason I'm a bit of snuffly with the cold. It's because I was up till 3 a.m. Clients were phoning me. I had 2 different funds reach out that I've not worked with before and say, by the way, views on X, Y, and Z. And I said, I'm contracted. I can't give you my views. However, the fact of the matter is, whether you like it or not, last night was a very big thing for markets. Not because we didn't know tariffs were coming. It's a big thing because we didn't know how Trump was going to play Canada, Switzerland, etc. Where he basically just, I view it, he freeballed it. And he went, okay, no deals are made. You get this, you get this, you get this. Now, what's happened is the new tariffs have come into effect, or will be coming into effect on 7th of August. Most countries have remained at 10%, but the other trading partners like Canada, Switzerland, and New Zealand are hit with tariffs up to 41%. Markets continue to treat this with some difference, probably on the view that the deals are still likely to be agreed in the coming weeks. We don't expect any meaningful implications for the dollar in the near term. Now, not for the dollar, but what you can see is things like the Swissie's taken a bit of a beating, especially Euro Swissie, I believe. We saw a bit of a spike on that, yeah. So not holding that. So if we just jump here, what we saw in essence for now is a bit of a flaw here. So this is where the market is sort of very indecisive with regards to the Swissie at the minute. The market initially did not like what it was told, and it's held that ground for the minute. Now, if we look at, so you can go over the core PCE, what's basically being said here is failing to show any particular concerns in uptick. Now, this is where the let's just say, how do I word this? Market can get ahead of itself, I guess. Now, initial jobless claims were unchanged, ticking up to 280 from 217, while continuing to claims held steady at 1946. Now, what happened here is, on this initial jobless, a lot of the market started saying, oh, strong employment levels. We saw decent data coming out of the GDP, at the PCE, etc. And the market moves towards, oh, we're going to get a strong NFP, right? However, I'll tell you this from experience. NFP is one of those prints that can go anyway. Always does. It's something that ADP always misses. There's never that one-to-one correlation. Now, overall, no data points were particularly market moving, nor do they firmly argue for another leg lower in the dollar. This is the main thing. We're in limbo with the dollar right now. Dixie ticked higher, mostly on the back of the post-Bank of Japan yen sell-off, but the dollar was mixed against G10. In our view, the growth reassessments after the EU-US deal and the Federal Reserve's hawkish stance is unlikely to have a lasting imprint, which I agree. The market will fade this dollar, in my opinion. The FX market is fundamentally data-driven at this point. It's almost like me and Mark have been screaming this since 2020. Now, today's jobs data presents the best chance for the dollar to take an extra leap higher before some pre-CPI, 12th of August, calm leaves the dollar, exposed to medium-term bearish repositioning. Payrolls consensus is 104. The whisper number is 120. Our call is 115. Fed Powell has placed greater emphasis on the unemployment rate, as he should, because that is the more reflective print, in my opinion, which is expected to rise marginally from 4.1% to 4.2, hardly enough to sound the alarm bells of the job market. We expect the 115K, 4.2% scenario as only marginally positive for the dollar. After this week's big run, it could simply lead to some consolidation. ISM manufacturing for July is also released today and is expected to have ticked higher. The impact for FX should be considerably more limited. Now, option markets pricing on calm August. It would be nice to have a calm August. I'm not going to lie. I'm fed up with this vol, which is weird as a trader. You usually say, give me as much vol as you want. I actually want a tame carry portfolio for August if I can. Now, before I pass it to Mark, because the only other thing I have really is, Mark, I'm going to leave you for the euro. I'm not going to speak. I can send you this link, but I'm not going to speak about the EU-US trade deal. We'll keep that for Europe, yeah?
Yeah, no worries.
Perfect. But one thing that I wanted to mention here is, where are we with regards to, short GJ, I know I like that. It is here. Okay. So dollar staged to come back and they see several reasons why. This is interesting. First, markets were likely liquidating short US dollar positions heading into this week's FOMC meeting. So basically, if you were short US dollar, you were taking profit. Second, the US-Europe trade deal was not clear positive for the euro, to the extent that it was one-sided where the US imposes tariffs on Europe, while the latter does not apply any tariffs on the US. Third, the starting point for euro-US dollar much higher at 116 and 117 compared to the pre-liberation levels at 108. These factors combined have likely driven the latest round of profit taken in long euro positions across speculative accounts. Now, you have to remember, a lot of the Dixie is made up of euro, so that could be a playing factor there. Beyond short-term positioning adjustments, we believe the US-Europe trade deal does provide some clarity to the ECB, where we expect just one more rate cut and a terminal of 1.75%. As such, once the Fed signals that it's ready to resume easing in the coming months, with growth in the US stepping down further in the second half of this year, Euro-US dollar could get renewed tailwind to climb above the highs seen this year. So that's just something that I wanted to comment on because ultimately, and I think me and Mark have seen this time and time again, and we laugh at this stage when people, oh my God, the dollar's rallying hard and stuff, and we're like, calm the hell down. Because ultimately, if you use some common sense here, how illogically short has the market been the dollar? The market's been hammering the dollar from tariffs, hammering the dollar from rate cut expectations, hammering it from data misses, etc. At some stage, you have to take profit. However, the structural cracks, in my opinion, still remain. The unemployment rate is still rising, which I just want to share my screen shortly and show you something. Gradually, we are seeing PMIs somewhat miss and hit. They're not consistently on a growth trajectory. We're seeing consumer confidences, or they're always, sorry, any Americans watching this, but they're always overly optimistic. So I tend to just push that. Retail sales have been hit and miss. We're seeing data points show you that this is more so peak of a cycle as opposed to continuous growth. Go back and do your research on when we were post-COVID or post-08, 09 crash, and you see continuous growth in data. We're not seeing that. We're seeing potholes form, which is where you have to start to be a bit more alert to data. Now, one final thing I want to show you, and I've mentioned this in previous breakdowns, is that if you pull up the unemployment rate, look at just something I want to show you here. Now, the last time we had anything above 4.2% in unemployment rate was October 2021. You are going to see the minute the unemployment rate goes above 4.2%, you are going to see articles left, right, and center. Whoa, highest unemployment level since October 2021, blah, 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 blah. In my opinion, that's going to be one of the biggest shifts for potential repricing. And that's why going into NFPs and going into unemployment rates, not that I'm saying holding dollar short plays makes sense, but having an idea of where those shorts may come in and looking for the repositioning on the pullbacks is how my brain is looking at things. So I guess I'll pass it to Mark now, but my summary of everything this week in short is very simple. Powell was on a hawkish tilt. The data has basically supported that tilt. The dollar has caught a bid, on both an unwinding of dollar short / profit taken on euro longs, coupled with, in actual fact, the repricing of rates to one cut expected this year as opposed to two. Now, rate repricing is very volatile. One data print, one comment can shift that pricing, one trade deal can shift that pricing. For now, if the data reaffirms one cut this year, the dollar should remain slightly on the bid. However, on the bid, to me, I think we're 50, 60% of that priced in already. I think the market is very aggressively front-loaded dollar strength. Mm-hmm. So that's my opinion, Mark.
So let's have a little look at the dollar. Obviously, what we spoke about on Tuesday is basically mostly come into pass. Obviously, we'd have to think in about an hour's time when NFP comes out. But like what we was talking about, like the Fed being a little bit more hawkish, the data holding relatively steady, that's already happened. So we were expecting a bit more dollar strength. And of course, as you know, if NFP comes out stronger today, or at least holds pretty good, then the dollar can rally a little bit further because people then start to price out September a bit more. And then that will obviously strengthen the dollar, as you know. And I believe, if I just quickly show my screen, I was just looking at seasonality. I don't really incorporate it too often, but I know people do like to look at it. And seasonality for August is a bit on the stronger side for the dollar. So just obviously for this one, euro weakness, so DXY strength, basically. So yeah, just be cautious of that as well. Everything is kind of coming into pass in terms of it's suggesting dollar strength. So we don't really want to be fighting that, I'll be honest with you. Now, dollar wraps up the first month of gains since Trump has taken office. Now, Powell also hinted on Wednesday that interest rates may stay elevated for longer, helping obviously push the dollar higher and trimming overall losses for the year to 6.7%. After a period of significant weakness, we have seen the dollar find some bids, given resiliency in the US economic data. I mean, basically, just go on to, I'll use Forex Factory just for ease of use. And then this week, and just look at the data this week, I think it's held relatively well, personally. I mean, GDP was pretty decent. That's price GDP. It's not too of importance at the moment, I'd say. It can come of importance soon, because people want to see if inflationary pressures are actually going to, go into the US due to tariffs, but we haven't really seen too much of that actually, to be fair. And yeah, apart from that, most of the other data has been pretty good. Of course, today's data we'll see, which is in about an hour's time. But if that holds pretty well, then the dollar can continue its strength further. And of course, resiliency in economic data, progress on tariff negotiations, and exhaustion in selling. And if you just look at the DXY as a good example, or let's just look at euro dollar, because that's a bit of a better gauge for DXY. If you're looking at COT data, you can see up here, basically a lot of this period here, this is longs and this is, if I just click this, I can't remember which color is which, but large speculators is in this red, green is small speculators. So obviously we're a bit more concerned on both, to be fair to you. This data is pulled from CFTC, so it should be pretty accurate. But you can see how since basically March time, elevated euro or basically massive selling in dollars happened. It made sense, but there was no reason to take profit. Like there was no reason for markets to be like, right, let's really drive down euro or let's really drive up the dollar, because each month had a bit of an issue for the dollar. But now we've seen that kind of shift quite quickly, actually, over about a week or two, where people are like, okay, maybe now the dollar can strengthen. So all we have to do really is, this is on the weekly, so if we just go on the daily, just for visually, it looks a bit easier. All we got to think about is, why has the dollar strengthened so much here? Of course, look on GU as well. Why has the dollar strengthened so much? And is that starting to change? Well, it's not really starting to change in terms of, okay, now let's start going back to selling. So therefore, the dollar remains stronger, if that makes sense. Up until we start to see something more of an issue coming into pass for the dollar, then you think, okay, now the dollar can sell off again. So as a result of that, based on what we've seen with the dollar, we could see like a bit more stronger. So like DXY could push to like 101, maybe 103 if we see a bit more on the reasoning side, if it still makes sense. But for now, 100 to maybe 102, just up to this high, seems pretty adequate. And in addition, interest rate swaps now show 36% chance of reduces in September and about 75% chance of a move in October, which was seen as sure thing before Powell spoke on Wednesday. Yeah, we looked at that on Tuesday about how I think it was about 60% chance at the time that an interest rate cut was going to happen in September. Obviously, we saw data, we've seen the Fed, and as a result, you can see now it's pushed all the way down towards 36%. If NFP comes out stronger today, or at least pretty good, that 36 will, of course, reduce towards, let's say, 20%, and then that could bid the dollar. And of course, as well, so October will also be reduced as well, maybe towards 65% or so. Now, the dollar plunge is also reflected among non-US investors. Hedge against the further declines in the currencies, said Standard Chartered Diego De Giorgi, said in an interview. And the US dollar is poised for further gains in the week ahead. Resilient US data, Fed that isn't ready to cut, and of course a wave of trade agreements are feeding into a stronger greenback, which is what we've seen. A lot of trade agreements. Some haven't obviously gone into agreement. I did see a decent map, actually, if I can find it again, where some trade, I'll see if I can find it throughout the breakdown, but there was a map that showed who had an agreement or not, unless it was on the main page. But I did see a map of who had the agreement or not. A large amount of the map was covered to say that there has been an agreement. There was only a couple of countries who still didn't make an agreement with the US. So I'd say that's pretty decent progress. And you got to remember, the reason why the dollar sold off so aggressively is because of all of the tariff issue. Well, most of that tariff issue should start to go away now. So as a result, you could start to see a bit of a pullback on the dollar. Don't get me wrong, we would still like to get back into a sell eventually. But I think we got to think about the near term and say, okay, there's nothing really telling us at this point that the dollar needs to go lower. So that is us on the USD. In terms of technicals, dollar CAD can actually probably go a bit higher. So if I just remove all of this and we'll remove, just actually, you know what? Let me just do this. We'll delete everything. Start from the beginning again. It's always good to refresh your chart every now and again. So for example, what we have to be thinking is top side for the dollar. So basically, where can the dollar go? And then we start to see some sort of resistance or some sort of selling pressure. Essentially, as you probably could guess, essentially into this high. So if we just round it to the next whole number, 140 would be that high that we could start to see some sort of selling pressure. Doesn't mean you now need to start selling from there, but it just means at least you'll start to see some take profit. So as a result of that, we know that's our target. So let's see how we can get in. Well, unfortunately, you can see that there's not many demand zones. So you may have to go a little bit aggressive. So you can see that there's one here. The next one I'd actually say around 37,800, essentially into these last highs here. And I believe that could be a slightly higher time frame. Okay, it's not. Just trying to see if there's a demand zone around here. Doesn't look like maybe a tiny 6 hour, but I wouldn't really be appetized by that. But around these highs is also where I'd like to see some sort of technicals turn in our direction. So either one of those are pretty decent from a fib perspective. Yeah, it's going to be pretty shallow pullbacks. Because we've got to think, I don't think we'll see too much aggressive selling in the dollar just because there's not a reason to do that. So I think pullbacks will be relatively shallow. Dollar Swiss as well. We were looking for buys. I don't know if we tapped into our zone. We didn't. We just missed it. It is what it is. So as a result of that, where can we come to next is where we're thinking. Well, if we go on the daily time frame, like what we spoke about on Tuesday, this high here, and then towards all these highs up here, well, I would probably think it could go a little bit higher over the near term, and then eventually a sell-off again. So let's just round it to the next number above 82, which would of course be 83, which then lines up with these highs here and that high there. So 83 would be the target. So as a result of that, where can we pull back? So if I just go on the 8 hour, maybe a shallow pullback. Looks like it's already tapped into it though on this wick here. And then obviously the best opportunity would be down there, but let's see how so it is Friday, and let's kind of see how it plays next week. But yeah, those would be the two main regions I'm watching. And then lastly, dollar yen. I mean, we have actually breached through 150, which was a big psychological number. Can we go higher? Maybe a little bit higher. I wouldn't say by too much though. So what we have to think now is, where is the highs? Have we tapped into any highs firstly? We're coming into this high, but then the next high is going to be about 153, 154 on dollar yen, which is entirely possible.
Something I'd add in here, Mark, I don't know if you agree with me here, is see above this 151 and a quarter level. The amount of people that are potentially taking speculative shorts right now with their stops above the high, if we get a very firm employment print, those stops get railed. So if you're a seller, your stop loss is a buy order. If we break through there, that's just going to inject buy liquidity into the market and help further fuel that move to 153s, 154s potentially. Yeah. What's interesting is now that Trump and have a trade deal, the question now becomes, if Japan intervene or stabilize their currency or whatnot, will he view them as a currency manipulator, or in actual fact, will he actually want a weaker dollar to help boost trade with them? You know, so it'll be interesting to see as we push back towards your sort of if we do 153s, 4s, 5s, 6s, just based on this stronger dollar narrative sticking. Do we see A, any BOJ talking or intervention sort of conversations, and B, if we do break this 151 and a quarter, do we see any triggers of stops that basically stick a load of testosterone and trend into this move and let it rally like hard? That'll be interesting for me. Or will the market use those stop loss, those buy orders, to sell their profits into, to then pull it lower? And this is more of a run on a stops level. So many things that could materialize from here.
Yeah. So it seems as if like the balance of risks are more pointed to the upside for the dollar, as you know. Essentially, to understand when the dollar now starts to sell off is just think opposite of what you're thinking now. So Fed is hawkish, data's holding pretty steady, and there's been a lot of good agreements with tariffs. Well, if we start to see data turn lower, then you could entail that that's probably likely going to come with a dovish Fed. And then that's when you start to get bearish the dollar again. But for now, because we haven't really seen too much weakness in the data over the past couple of weeks, the dollar should remain stronger. The Fed is a little bit more hawkish, as Drew spoke about. As a result of that, that's all we're thinking about for the time being, is data's holding good, Fed is hawkish, dollar stronger. If NFP comes out and pretty decent today, we don't need it to be extremely strong. We just need it to hold pretty well. The dollar can then continue to rally, and then you think, okay, like for example, euro dollar 112 would be the next handle. GU, we spoke about 130 as the next handle, then 128. And then that would be really good buying opportunity when the time comes to pass, shall we say. But yeah, apart from that, that's myself. Unless you had anything to add on to technicals, Drew.
Not necessarily dollar technicals. Yeah, I mean, I just think if you look at dollar Swissy, you look at dollar yen, you look at dollar CAD, the sort of levels being built. The only thing I'm concerned with dollar CAD is we are trading into a weekly area of supply. Not that I'd want to be a buyer of the Canadian dollar in the current environment, especially with Mark Carney bumping his gums. I don't really want to be a buyer of the Canadian dollar right now. However, I'd rather express like some sort of high yielder, stable region like euro, pound against the Canadian dollar. But what I will say is you are trading into a key level of sort of 139 to 140 in that weekly supply. So just be careful of that. Dollar yen we've gone over, and dollar Swiss, there's not, again, it's in a weekly supply. There's a lot of higher time frame areas of supply right now. However, as we always say, fundamental and risk sentiment will always lay your thinking for technicals. Just because you're in a weekly area of supply does not mean the supply will hold. If the fundamentals are strong enough, it will push through that because the demand for the currency outweighs, of course, the technical input. I guess my summary is we're going to be on the breakdown anyway for the NFP. Yeah. I guess my summary is first of all, you've got to witness mine and Mark's sort of thinking going into the print. When you take the cumulative inputs of variables given to you this week and you look at it holistically, Trump, Powell, and data has basically been your three talking points. From a Trump point of view, we've had tariffs, a slew of tariffs, not much changing, but the ones that have changed significantly. Canada, Switzerland, etc. Will deals be made? Let's see. We don't know yet. Nothing has been done with China yet. They've deferred that for another 90 days. So the tariff it's a lingering factor. It has put a bit of volatility, slight touch of vol into the market. However, the market's basically saying we've been here since April. Like, come on, just tell us the definitive figure, which we did get, to be fair, on the majority of deals. From a Powell point of view, we were on a hawkish tilt. Main reason being he acknowledged the inflationary pressures from the tariffs that may materialize. And he basically warned Trump by saying, you're lucky I'm not hiking. I'm looking through this inflation just by holding rates. But however, he did acknowledge by holding rates and acknowledging inflation, couple that with a strong GDP in the PCE, the market's moved towards one cut. This brings me on to the final thing, which is rates. Now, subject to how the unemployment rate comes out today and how the CPI comes out mid-August, I think it's the 12th to 15th sort of thing, will basically cement the rest of August's trading, in my opinion, with regards to do we get one or two cuts. Mm-hmm. So then it's basically a matter of how good are you technically with profit-taking pullbacks, etc. For now, there's very little reason to be going immediately short the dollar, is the best way I can view it. However, I do remain structurally a dollar bear. Regardless of the earnings and etc., I do think the cracks are showing. The higher you keep rates here, logically, because the three golden brothers, your GDP, your inflation, and your interest rates. The higher you keep rates here, there's less supply of money that will come into the market, and inflation should ease over time. However, if inflation does not ease over time, and it's due to an external factor like tariffs, this is not going to be a demand-led type of inflation. It's going to be a supply-led type of inflation, which is the worst type. You want inflation to be materialized from spending, not from external inputs. So if we do see rates remain higher for longer and we do see inflation rise in this, I believe it's only a matter of time before growth starts to stall and slow. And that's when you have basically a stagflating economy. Mm-hmm. So to me, as ING said, and as MUFG said, and I agree with this, I understand why the dollar is bid right now. And I could understand why it would remain slightly bid going into the first potential week of August, for example. However, do I change myself as a structurally dollar bear? No, I don't. I still think the rotation out of US assets will continue. And I still think the dollar will remain on that longer term trending lower sort of up. So that's my take. Even in the face of all this euro dollar big sell-off, pound dollar big sell-off, etc., I still stand there and say, doesn't faze me. I still think the dollar will remain more so on the weaker front. And not just that, not to bore you with the history of it, but if you look at the current levels the yields are at, and the fact the Fed would have to refinance at these rates, they either need to do one thing, pull yields lower to basically refinance at a cheaper rate, or they need to weaken their currency to basically incentivize people to buy that debt off them at the higher rate. Mm-hmm. So which one's more likely to occur? Well, we know inflation is likely to occur because of tariffs. We know the data is holding up firm. We know rates are remaining high, which leaves you with the probability that they're going to have to somehow try and incentivize you to buy that debt, which is largely through a weaker currency, most likely. So to me, structurally, probabilities, etc., in my favor of a weaker dollar over a long period of time. However, I acknowledge that you could still get a slightly bid dollar as the market does what? It reacts. It's a reaction function to what's currently going on. But structurally, I think myself and Mark are in agreement with a weaker dollar to persist over time, especially in the second half of this year. Anything to add on to that, Mr. Fraser?
Nope. Nothing to add on to that.
Nobody know. I guess that's the summary then.
Cool. So that's us on the dollar. Let's move straight on to the pound.
Okay, so the pound. Now, this is going to be relatively quick because it's been a very quiet week for the pound. There's one very scary but interesting stat that's come out, which I'm going to jump into. But as you can see, very little market moving data from the pound. We had a bit of consumer credit, a bit of mortgage approvals, and then very, very quiet pound week. Truthfully, that's it. I mean, we do have a fair bit next week. We've got Bank of England interest rates, so that's going to be expected cut. So it'll be interesting to see how the market basically digests that and the rhetoric that is given to us. However, this is what I want to go over. First of all, UBS. They say Following the tariff news-driven dollar rally, which pressured cable back below 134, the focus will shift to the Bank of England's meeting next week. We have long argued for a quarterly rate cut pace and hold on to this view. This means we expect the BOE to reduce rates 25 basis points on the 7th of August, much in line with the pricing. This should not affect the pound markedly in the short run. Nevertheless, we'll be closely watching any commentary by central bankers on the latest labour market weakness, as this constitutes a risk for a more pronounced policy easing. A dovish vote split, so the vote split's going to be important, or commentary might push cable back to 132. However, with wage growth remaining uncomfortably high, so that's the wage inflation. Those of you that have done any one-to-ones with me, this is what I refer to as that wage inflation spiral that we've seen. And what a wage inflation spiral is, when inflation rises in the UK, or globally, or wherever region you're in, employees demand more money. And then because they get paid more money, they spend that increase in wage, and that keeps pushing prices higher and higher, and you get a wage spiral. Now, what they're saying here is we've got a wage growth remaining uncomfortably high and inflation well above target. And that's why the Bank of England are very reluctant not to cut, because specifically the wage inflation is also coming from the service sector, which is 80% of our GDP. Now, we argue it's still too early for such considerations and rather see US-specific news the drivers seek to push cable up again. So you're going to have to see a weaker dollar to pull G higher is what they're saying. But they do say, go short GJ. They say we like to be short GJ at the current spot of 197.5. So they're currently 50 pips in drawdown, targeting a move to 192.5 with a stop at 200.5. From a technical perspective, the upward momentum in this pair seems to be rolling over after rising from 185 in mid-April to nearly 200 in mid-July. The selling pressure on the yen should abate further following the passing of Japan's upper house election and the achievement of the trade deal. While interest rates markets are fully priced for a rate cut by the BOE next week, overall, it is currently pricing only 70 basis points for the next 12 months, which looks conservative relative to our expectations for 100 basis points of cuts. Hence, we see scope for further rate cuts to be priced in, especially if the BOE starts to adopt more of an aggressive easing bias to shore up growth, with macro data having been on the more disappointing side. Now, I just want to stop sharing my screen and mention something. I tend to be early. I've mentioned this many times. Me and Mark have a tendency, because we are macro driven, we tend to be early to trade ideas, which is fine because we see the crack showing before they technically emerge. I'm stating this now on the 1st of August, so this will be one of those situations where I pull this clip back up hopefully in 3 or 4 months and we say Mark's smiling, I'm smiling, we say, yeah, we were good here. Here's my view on the pound, giving you a bit of an overarching view, because we've had a quiet domestic week this week, so I'll give you more of a longer term thinking before interest rates next week and whatnot. I personally believe right now that the market is underpriced the amount of cuts we are going to get from the Bank of England. And the reason I think that is because the market is under the influence of the fact that yields are elevated right now, and that the pound is catching a yield differential, yield spread based bid and rate diff based bid, which is fine. It makes sense on the front of it to be buying the pound on a rate diff yield spread, fine. However, I believe the market is underpriced cuts, because I think what will happen is the data is going to slow from 2 fronts. The data will slow due to the elevated interest rates in the UK, dragging on borrowing costs, dragging on the supply of money entering the market, and basically further fueling basically a drop-off in consumption. Now, when you couple that with the increase in the corporate taxes we're likely going to see in the NI, etc., from the Labour government, because they did not manage to push through a cut to welfare spending, I believe once the Labour in their autumn budget potentially raise corporate taxes again and basically make conditions harder for businesses inside the UK once again, I think what actually will happen is the business output will slow, unemployment rate will rise more than is forecasted, and I think consumption will drop off at a faster rate. So my base case for the second half of this year is actually a pretty weak. Now, that excludes cable GU, because of course that's more of a dollar story. I'm being tactile here. I'm thinking more things like Euro GBP upside. Even though Euro had a higher tariff, Euro has way more stable fundamentals in the UK. On top of that, I think pound yen downside with a hawkish BOJ and them being one of the only developed central banks that are raising rates. I think pound yen could have some tremendous downside so long as the sentiment remains stable to be a buyer of yen. So I'm looking at pound yen downside. I'm looking at Euro GBP upside. However, in the short term, like I said in previous breakdowns, tactile GA longs and GN longs I'm not going to argue with, but that's my view on the pound. Now, what reinforces this thinking is the cracks that are showing, such as pound sterling business confidence hits crisis levels. Now, this is one of many, many red flags that are starting to emerge. Now, investment intentions, headcounts of staff, and revenues at British businesses are all expected to fall, according to a new business survey. This is according to the latest edition of the Institute of Directors Economic Confidence Index, which has fallen to its lowest level since its inception in 2016 at -72, down from -53 in June. UK business leaders have entered the summer with the lowest confidence levels we've seen since our records began in 2016. Companies continue to battle cost increases, particularly arising from the national minimum wage and NI changes. And many are frustrated that while the government has been quick to raise costs for businesses, it has been much slower to deliver improvements for wider business environment, in other words, lower rates. The findings shine a new light on the poor macroeconomic environment in the UK that will ensure the pound will continue to struggle against the euro and the dollar. The mood surrounding the pound has soared in recent weeks as dovish comments by the BOE Governor Bailey on the labour market and interest rates put investors on notice for potential further losses ahead. Although the pound has recovered against the euro over the recent days and low volatility conditions during the summer could offer near-term support, i.e. carry trades, because like I said, the pound has the rate diff, the yield spread advantage. Headwinds could start to blow again in the autumn when Rachel Reeves delivers the next budget that is likely to include further tax rises, and as she seeks to fund the government's staggering expenditures, which is a 20 billion hole, by the way. So again, I'm just going to stop sharing my screen here and let me give you some more logic. Let's just take somebody who's not a trader, somebody, I don't know, I'm speaking with an uncle of mine or a shop owner locally, whatever, and I say, how do you feel about the fact that taxes are going to increase? Minimum wage is going to increase again. NI is going to increase again, it's national insurance. How does that make you feel? They'd say, well, this is going to hurt my margins. Every business is going to say this is going to hurt my margins. I'm going to make less money. And as a business owner, I want to make as much money as I can. So what am I going to do to help basically increase my margins on my business? There's two things I can do. I can either push costs onto consumers and increase my prices so I make more money. However, if consumers aren't consuming much anyway, if I raise my prices further, it's just going to lead to basically a point of drop off into oblivion where nobody's going to buy my product or service. So what's my other option I can do to increase the health of my business or make my margins more viable? Well, I can reduce my overheads. Well, how am I going to reduce my overheads? I can let go of staff. I can shut down a premises or two. I can buy less materials. I can try and lean my operations out. However you look at this, what it does is it drops the amount of money coming into the UK economy from business to business, consumer to business, every angle. So this is why I'm starting to say that one must start to consider the live risks this autumn budget presents the UK. And this is more of a fiscal risk as opposed to a macro risk, if you like. But the fiscal risk and the fiscal alterations will materialize within the macro environment because that's how the economy is going to be basically reacting and basically like surviving and trading is through the policies that are presented to it. So to me, there is huge economic health risk from this poor policy management, in my opinion. Now, jumping down, last year, damaging speculation around tax rises in the lead up to the 2024 budget caused many firms to pause investment and hiring decisions. And I think this is what we may start to see again, contributing to 6 months of zero economic growth. Okay, that's what we saw. 6 months of zero economic growth. We're now living with economic consequences of those tax hikes. What are we going to see next time? Now, again, if I just open this chart, so you can see now May 24 here. So new Labour government, bang. And what is this? It's Directors Economic Confidence Index. So as soon as that Labour government came in, they announced the autumn budget. Okay, we've increased, then we've melted to record lows not seen since 2016. Basically, since we left Brexit or since the referendum. Now, she says the government must urgently calm businesses' nerves by ruling out new taxes. Now, if they do rule out new taxes, by the way, I expect a surge in the pound. Or at least I expect this to be a positive sentiment drive for the pound. The IOD survey showed business investment intentions. So the intentions of businesses to invest into the economy, into staff, into infrastructure, etc., fell to -27 from -10%. And revenue expectations fell to -8 from +8. Businesses' headcount expectations fell to -23 from -10. So they're saying we expect to invest less, to have less revenue, and we expect to fire more people. What do you think this looks like, guys and girls, in the face of your business confidence levels, your PMI levels, your consumer confidence levels, your retail sales levels? What do you think happens with this data? How will that data materialize in this environment? Now, the deterioration in employment intentions corroborates evidence elsewhere of growing downside risk to the UK labour market as companies battle with the additional costs imposed by Reeves in last November's budget when she hiked national insurance contributions taxes on businesses. Survey respondents widely commented on the need to reduce headcounts in response to higher payroll costs and subdued consumer demand. Chris Williams, chief economist at S&P Global Market Intelligence, compilers of the PMI, so this is somebody who actually makes the PMI report, said what is particularly worrying is the sustained impact of the budget measures on employment. So that's what I mean, the sustained impact, the long-term impact. The data will likely just compoundly get worse. The UK data dump over the past couple of days show an economy running at half of the pace at the start of the summer. These data show that there is growing scope for the Bank of England to cut interest rates again when it meets next week. However, the pound, and for the pound financial markets, it will be guidance on what comes next that will matter. If the bank signals it will cut by more than the additional 50 basis points of cuts expected in the next 6 months, the pound can come under new pressure. More cuts would be warranted given the travel in the UK economic data, so the trend and the trajectory of the data, particularly the labour market. However, inflation remains stubbornly high, with food inflation surging and all signs suggesting the bank's long-predicted fall in inflation is still some way off. The British Retail Consortium said Thursday that food inflation has risen 4% year on year and it could reach 6% by Christmas. So to me, that is stagflation on the horizon further. Food inflation is particularly instrumental in forming consumer views on the outlook on inflation, which means it can set overall expectations for inflation higher. This is something the BOE is particularly wary of. And this is just not good news. Now, this would argue against cutting rates too deep and too soon for risk of completely shooting its own credibility or basically re-emerging inflation. Now, in fact, economists at Pantheon Macroeconomics, the independent researcher, think there is only one more interest rate cut to come from the Bank of England owing to its inflation persistence. Now, again, I'm going to stop sharing my screen and give you that view. Let's say the Bank of England do cut one more time, and then they say we're done because we have stubborn inflation and they want to keep a cap on this inflation. They don't want inflation to rise further. I believe then what will happen is if the Bank of England only cut once and they sit there and say we can't cut any further because inflation is still elevated, I think if the data continues to materialize worse, as we've discussed, headcounts are down, revenues are down, investment is down from a business and consumer point of view, what do I think will happen then? I think you'll get a surge in the UK yields. Twos, tens will start to ramp up, the yields will spike as investors dump UK bonds because they believe there is basically fiscal stability threats and they believe that the UK is essentially at a stage where they can't recoup the revenues to pay off the debts that they're taking on. So if that's the case, I think what you may see is another situation where yields are rising in a negative way, where the market is selling UK bonds off. And basically the government have to own up to their mistakes in that environment. What does that look like? Once again, that looks like a weak UK British pound, Great British pound in that environment. Structural changes, particularly de-anchored inflation expectations and greater real wage resistance, are supporting wage growth and price inflation for given slack in the economy. The combination of deteriorating growth and elevated inflation creates an economic phenomenon known as stagflation. It is a difficult environment for central bankers to navigate as they are unable to provide support via lower rates for fear of overstimulating inflation. Higher interest rates would normally tend to support the pound. However, poor economic growth means this might not be likely, particularly if the poor economy means Treasury doesn't collect as much tax as we expect, i.e. yields surge in that environment. This will lead to more borrowing and increasingly regular episodes of bond sell-offs and yields spike on a bond sell-off as investors are unwilling to lend to the UK. For the pound, the ultimate risk is full-blown UK debt crisis, which I think is a real, I'd say this is a 50% likelihood of this occurring, which becomes increasingly likely as long as the country stays in its current trajectory. So to me, guys and girls, what does that look like? It looks like pound weakness, okay? So, I'm not going to make a bold call here, but I'll tell you what, I'd be very surprised if the pound sustains for a long period of time, anything above 200 to 201 on GJ. I think really speaking, fair value on GJs, as the FIB would recommend, I think a fair price on GJs anywhere from 190 to 193, which at the minute, about the 192 and a half, which at the minute we are about 500 pips, 600 pips above that. So looking at the technical aspect of it, and that's basically what I have this week, is I believe remaining tactically short the pound makes sense. If you are buying it on yield diff, rate diff, tactile, I think that's a very short-term way of thinking just because of low volume of summer flow, basically. So what I would then be looking at in this environment is I'd be looking at some sort of either hedging approach, or to me, I think remaining short the pound makes sense. So I was watching this level for GA, shorts, however, with the intention of hedging it somewhere down at these levels, okay? That's where I'm currently looking at, between 204 to 206.750. Pound CAD, I was expecting a bit of a push on pound CAD, but of course, oil prices bounced a bit, and we're seeing slight sort of, I'd say, more pound weakness than anything else. So I'd be saying 183.750 is my next point of interest, and I'd like to see this fall to the 182 level, which is a higher time frame monthly area of demand, I believe. No, it's not. Is it a 12-hour then? Maybe I've calculated that. However, this would be something that would make a bit more sense. Pound Swissy, again, Pound Swissy is just rejecting that 108 and holding that 106.5. I think here's our range for now. Pound yen, it did come out of this daily, not cleanly, however. It came out of this daily at the 197 region. And we have now actually rejected 199.5. So I would say now you have to basically wait for a break of either direction. If you get a break here, here's your pullback. However, if this holds and you get a pull here, this will then be the next pullback, if that makes sense. So I'm just waiting for a decisive move on GJ. We sort of, as expected, broke this high here, traded higher, pulled back into where I was expecting, and we rallied out of it. I didn't take this trade, however. Would there have been an entry signal for me? There would have off the handle. And in this example, just for back testing reasons, I'll show you how I would have run this. I would have traded I'll place my stop below the 223.5 level, which is where the orders last came in. My 2-to-1 would have been here. So we just would have de-risked. And then my conservative exit would have been up in this region. That's how I would have traded that. However, I did not take this trade. That's more for the algorithmic hedge fund and stuff. So now, GU, I expect to remain short this. And I think we could have potential, subject to how the data comes out, I think we could have potential legs into the 129.5 to 130 level, which is this weekly demand, subject to how the US data evolves. This is a key level, this 131.5. We've sort of built a level here at the minute. If I just show you, we've built a level here at the minute, which is going to get railed. It's just when does it get railed? Now, that's why I'm saying I'm not really keen on shallower pullbacks, but in this environment, it does make sense. We may get the NFP volatility present some sort of pullback for us to then go short. My best guess, though, is that we do not get that pullback. And I think what will actually happen is some sort of consolidation spike. I think, we may get a 40 pip move to the upside, something like that. 132 may actually be the trade. However, I will not be trading 132. It's just not, for me, the supply doesn't make sense. It's too shallow. The data's not there. You've got a 2 hour there. You don't have a 4 hour there. You don't have a 6. You don't have an 8. You don't have a 12. To me, the data does not corroborate with me getting short there. It'd be a gamble. That's how I view that price. I'd take 132.25, however, to 132.5, because that lines up with how I think. And this is why, you survive in a market, because you have a plan and you trade that plan. So what I will say is keep eye on very important levels on the UK bond market. 4% is key. Last time we had the Liz Truss blow up, we had like a move like this. If we get another budget blow up in the UK, we've seen yields basically pump from 1.5%, to 4.75%. You could see a move like this on the 2s, or you could see a move like this on the 10s, where the market goes, we demand a high yield to buy your debt because we do not think you can pay that back if the budget gets as bad as I'm potentially fearing it could. So what's my summary on it? BOE rhetoric next week is very important for the short to medium term direction of the pound. However, if the data continues to fragment in ways that are contradictory, so for example, the business confidence is dropping, however, the inflation is high. The consumer confidence is dropping, however, again, inflation is high. If you're seeing this data sort of diverge further, this increases the probability of stagflation for me. However, I cut this. I'm not a long-term pound bull. I was sort of bullish the pound Q1, Q2 based on rate diff yield spreads, but I think that's been baked into price and it's been and gone. Now looking at the structure of the UK and the actual macro underlying drivers of the UK, there is severe risk to the actual fiscal stability of the UK, which will then materialize into a poor macro backdrop, in my opinion, which leads me to believe that, if you're looking at the pound, you have to be basically, if you're selling this pound in this environment, you have to be very tactile of how you're approaching it. Pound Swissy shorts could be a great play. Pound yen shorts, and arguably the dollar if the dollar holds up firm, but I don't think the dollar will. I think you could see a scenario where the pound is range bound against the dollar from say 128 to 135 sort of market, but pound yen's getting hammered sort of play. Could easily materialize. You could see a decoupling on that front. So yeah, that's me on the pound mark. Unless you got anything to add?
No, not on the pound. There's not much positives at the moment, so I don't think there's too much strength. Yeah, not much strength to come from it, to be honest with you. So yeah, everything you said was pretty good.
Cool. So that is us on the pound, guys and girls. Let's jump into the euro.
So the euro, as you may see on technicals, the euro has been selling off for a decent amount of time this week, mostly across the board actually. Euro CAD is lower. Euro GBP did come lower over this first half of this week. We are pulling back a little bit now. Euro New Zealand, similar as Euro GBP, and of course Euro dollar, mostly on the dollar front there, but it is also impacting what the euro does as well. And let me quickly share this Bloomberg article, and it is pretty good. They do talk about why the euro is pretty much weak. And we'll mostly work on this one today because they talk about everything we need to know. Now, the euro is headed for the worst week in almost 3 years against the dollar as concerns seeped into the market about economic impact of Europe's trade deal with the US. Like we spoke about on Tuesday, again, like it gives some confidence for companies in terms of there's not much uncertainty anymore. But what we do know is these tariffs can impact the growth projections for Europe. And that's why people are like, okay, this may not be too good. And that's kind of what we need to focus on is that these, you know, I believe it's 15% baseline. Yeah, 50% tariffs is not exactly going to be too good for growth for the region. As a result, how do you interpret that? Well, the main thing you think about is if growth comes lower, what naturally could happen to inflation? Or what, more importantly, what could happen for the ECB? They would probably need to be a little bit more dovish in the future as a result of that. Obviously, it's still early days, and we'd have to still see over the next few months of how is this impacting growth. But for now, that's kind of what markets are what people are thinking about is it's probably not going to be too good for growth, and the ECB may need to then cut by a little bit more than they may have wanted to. Now, some market participants have been questioning whether this is a turning point for the euro, which touched a 3-month high at the start of July. The currency has been a key beneficiary of investors diversifying their holdings outside of the US and has also drawn some support from Germany's plan to ramp up government spending. But the optimism waned this week, with Europe seen as the loser in a trade deal that places 15% of tariffs on its exports. The fallout from the EU to US trade deal has been in the wake up call for investors regarding the headwind that faced the Eurozone economy, said Jane Foley at Rabobank Drew's Financial Crush. That's to spark the profit taking in the euro. And while the trade deal reached on Sunday allowed Europe to avoid a full-blown trade war, basically, as you may have saw, heading into sort of this week, people are talking about maybe there's going to be like Europe raises tariffs, US raises tariffs, Europe, and it will be like a tit for tat. But obviously, that's not the case anymore. So that's somewhat of good news. But it's the fact that this trade deal is probably going to harm euro more than it is for US. And the Eurozone will be a loser. So much about the future world trade system remains unclear and will likely do for some time. Whatever happens, the EU will not come out on top, given how much it has conceded so far. The Eurozone growth was already set to be the second slowest among G10 after Japan in 2025, according to the forecasts on Bloomberg. Now those forecasts may be revised even lower, possibly Europe's growth being the slowest in G10. So let's see if once the updates are done, we'll see what people are thinking. Now, holding a long position in the euro to prepare for a prolonged downturn in the greenback has been the market's favorite trade this year, which, as you know, has been us as well. You know, we have moved quite a lot for euro dollar already in terms of this move here. You know, we were speaking about that as well. And Barclays forecasting further gains in the common currency. Morgan Stanley and Barclays, or two Barclays, forecasting common currency to go further, which can still happen. Don't get me wrong. But what we have to think about, basically, obviously, August is a bit of a stronger month for the dollar. So we could see a bit more lower euro dollar, which is kind of what may happen, or what would likely happen, in my opinion. But as we get towards September, all we have to do is just monitor the reasoning as to why euro is lower. And if that's not really picking up, then we could see lower euro dollar. But hopefully, fingers crossed, it does start to pick up. And then we could start then going back along the euro. But for now, the balance of risks is more pointed lower for the euro. And we were long euro dollar for 108, said Niall at a portfolio manager firm. Given what we've seen this week in terms of the trade deal and Powell's commentary, we felt it was prudent to take that position off, which is true. People are now starting to think euro could probably come a little bit lower. Now, the Eurozone flash CPI, which did come out this morning, actually, NFP's in about a minute and a half, so we'll look at that. But inflation, as you can see, we came in at 2.3%, and that's on the core. And CPI did come towards 2%, which was a little bit stronger, but you can see markets aren't too concerned about that. Like you would have expected a little bit of a stronger euro, but people aren't really focused on it. They're thinking about the next month or so. Now, following a sub-consensus 1.8% print on Germany, expectations are a modest slowdown from 2% to 1.9%. Obviously, we've just seen that it has stayed kind of the same, and core is remaining unchanged. That may not trigger any serious dovish repricing, but equally could prevent any residual cut speculation from being entirely priced out. As discussed above, US jobs may represent best opportunity for a drop to 113 in euro dollar before CPI figures later in August.
To interrupt, Mark, I think we should just come to the chart with this NFP coming out.
Oh yeah, let's do that now. So
if you put up twos your side and Dixie, or twos and something like euro dollar or cable, just something major.
No worries. We'll do that. Let's go in the hourly just so we can see it a bit better. So it's in about 5 seconds. Let's see. Let me see on here. Cool. It should be out now. Participation rate.
Okay.
Average
11. Jesus Christ.
US.
73K. That's a huge miss.
Oof.
That's a miss. That is a miss, me old boy.
73K.
Lord have mercy. Gold is up. Silver's having a cable's pulling back, although this could present an opportunity to go short that 132.25. Euro dollar's bouncing the 114, bang on the sweet nut. It's at 114.5. Twos have literally kissed the fours and said goodnight. That is hilarious how we nailed the 4% mark on the yields. Are you seeing that on the twos?
Let me get that.
Get wrecked. Look at that on the two. Look at that. Goldman, make me a director.
May was revised down by 125K from 144 to only plus 19. And the change for June revised down from 133 from 147 to 14,000. With these, the revision deployment in May and June combined is 258,000 lower than previously reported. So that's quite a large amount of revisions there. Obviously, as you know, revisions are also important. Let me screenshot that and put it in the Discord for us. But what's the other one? What's the unemployment rate? Okay, that's that came in at consensus at 4.2%. How is currencies reacting now? Let's see.
That is hilarious how we nailed the fixed income side of it, though. I knew that 4%. Do you know, I might start trading fixed income, I swear to God.
GU?
Dollar yen's taking a dump. Dollar Swiss has come out of that 180 spot 81,750-ish. Dollar CAD not even looking at. Cable is where I want to get short, though. This is the interesting one. Cable is the very interesting one.
Let's have a look.
However, as if I'm going to rush a position in this volatility. If I was floating some good margin on cable, I would roll some of my position into it via limits, but that's just not wise because I'm not rolling anything through. Interesting, by the way, is Aussie US dollar off the 64.250. Do you realize how a lot of the price came in on the NFP sat at these levels, like euro dollar 114, AU spot 64.250, cable sat at the 131.5. Like, it just goes to show how basically books our position in response to said flow. Very reminiscent of my time at an intermediary desk, intermediary banking desk.
Yeah, let's see Treasury as well. So we
Gold said goodnight, God bless. Nice to know you were selling me.
So let me refresh this.
Equities broke the July low. Sorry, Dow broke the July low. Yeah, Mark, I might just start becoming one of these news traders and just start throwing on a load of risk before the print.
Ooh,
you remember like Giuseppe Della Motta, how he does it?
Oh yeah. Cool. So we'll come back to this towards the end of the breakdown just to see how, as you know, markets have interpreted it. But based on the reaction function, obviously it's not a good print. We had a lot of big revisions to the downside, like what we've seen on this thing here that I've highlighted. Employment in May and June combined is 258,000 lower than previously reported. So yeah, it's not a good figure, let's be honest. I just want to double check.
I tell you what, the market was not priced for that. Let me look at the CMEs a sec.
I don't think it's changed too much at the moment.
We'll
have a look and see soon. Whilst Drew's talking, I'll have a little look and see what the reasoning for the big move to the downside was driven by. But I'll have to go through all of these and just see which ones of importance should be seasonally adjusted one. Established ones is also important to watch, but based on this one, where are we? July 2025. The biggest drops was goods producing, non-durable goods, and wholesale. So a bit more on the secular jobs that could be impacted by the tariffs, or what would be impacted by the tariffs, shall we say. So yeah, we'll come back to this and see. But yeah, based on what we've just seen, it doesn't look too good. I'll be honest. Lastly, let me just quickly read through, see what the live updates are saying. Private sector payrolls was revised to just 3,000 in June. July saw a pickup to 83%, but that's a net another week reading. At the first glance, these numbers would support the argument that this labor market is slowing and becoming more vulnerable. Government jobs has declined, potentially showing the effects of federal spending cuts. Okay, cool. Note that then for very big indeed. That makes 73K for July look all the weaker. Yeah, that's true. So if you've seen that the largest, like the last 2 months, we've revised quite massively lower. This, what people would entail is this 73K that we've just seen today would also be revised lower at the next meeting if we judge based on what we've seen over the past 2 months or so. But yeah, we'll get back to that and have a little look. But yeah, barring any surprise today, we think the next few days could support euro dollar for 111, 115. Sorry, a potential retest of 115. So yeah, I mean, obviously we've not seen that. So what we have to think about now is, does this change the narrative back for the dollar? I mean, it definitely stings the upside in the dollar. I'll be honest. Like, can we get back to 101?
The question is, it's not whether. The question is, how does, first of all, the twos have rejected 4%, which is a huge thing.
Yeah.
The second thing to think about here is, how does the market digest this in terms of where interest rates at the end of the year? Because essentially, if they're revising previous prints whilst the unemployment rates ticked higher, if you now see a continuation of unemployment rate ticking higher in conjunction with inflation moving higher and growth eventually starts to slow, you're stagflating, mate. So in that environment, the market would either move to aggressive cut pricing or basically a dumping of US debt, because they were the same situation as the UK. We require more yield to buy your debt if there's more fiscal risk, especially given they just pushed through a was it 5 trillion additional debt on the big?
Yeah, I believe it was that much.
Hey, gold's a good payday though. Merci. Oof, oof indeed. Gold said wham bam, thank you, man, didn't it?
It did. Just trying to see where it rejected from. It looks like it just reacted out of that 4-hour demand zone here initially, and then pulled back into
3,340 is going to be likely a profit taking region. So we're nearly there now. 3,340.
Yeah.
Is that what you had eyes on?
What are you talking about? Take profit.
Basically, take this high now, and if you go to, let me put up my chart. If you go to, no, sorry, I'm thinking silver. Yeah, 3,340 simply on the basis of running this high. And the previous orders that came in pushing this to the downside was 3,345, causing a 8-hour supply. So 3,345 was the sell-off move. Basically, 2 candles to your left. That was about 50 candles. Yeah, there. So the wick high of that is 3,345 that caused this move to the downside. So that's why I'd be saying 3,340 may be a bit of a struggle region as we break this high.
Yeah. So let's see how this plays. The next hour candle could give us a very good guidance on what people's interpretation is. But based on what we've seen, it just doesn't. It's not great. I'll be honest. One is a pessimistic path where deterioration in the labor market and economic weakness spur officials to offer more support, basically to cut. But the more optimistic side path is where the economy holds up and inflation keeps coming down, leading officials to make more rates more restrictive. The job report doesn't offer conclusive evidence, or which is more likely, but further increases the unemployment rate and further declines in job growth, could lead us down that pessimistic path. Okay, cool. So yeah, apart from that, I mean, we'll have a quick little look at UBS and what they are suggesting. So it is over here. And they say the summer lull, which is basically what we're talking about, seasonality. Following last week's ECB meeting and this week's trade deal, the start of August marks the official beginning of the summer lull in Europe. The Eurozone data calendar is very light next week, with final PMIs and Euro area producer prices on Tuesday and retail sales on Wednesday. None of which are likely to move markets significantly, which is true, unless you see significant changes like what we saw today with NFP. But if it doesn't, stays around where it is, shouldn't do too much. As earnings season accelerates, the company commentary on the trade war may influence equity indices and by extension the euro. However, the euro is likely to remain more sensitive to further trade-related headlines, especially as a recently agreed 15% tariff deal between the EU and US appears to rest on shaky ground. We highlighted trade agreements could trigger a short-term bounce in the dollar. Nonetheless, we continue to anticipate a weaker dollar through the remainder of the year as the Fed resumed cuts and the US macro data softens in the second half, which is, I mean, we have seen it soften, as you've seen with the NFP revisions. This will then eventually bleed through into the PMI data. The PMI data should then start to come lower eventually, substantially lower, shall we say. Unemployment rate would then start to tick up more and more and more. And of course, how you'd interpret that is, well, the Fed then should start to cut more and the dollar should remain weaker. And against this backdrop, we favor establishing euro-dollar long positions below 115, targeting a move toward 120. So what they're saying is any moves below 115 is an opportunity to buy, which kind of what we've seen over the past couple of days anyway. We were at 114. We have rejected 114 based on today's data. So this is a good example, actually, where it comes into a key level and it doesn't have a reason to trade below that key level. So like 114 and then 112. Similarly here, 115, we had that reason on the Fed print. Cool. It traded below that. We then got toward 114, which is kind of nearer term region. It didn't have that reason until NFP, and then it started to rally. For example, if we come to toward 112, if we haven't got a reason to trade below 112, it will reject 112 and go higher. Does that make sense? So you just kind of work with what the data is telling you and thinking, okay, which zone or which region is more likely to hold or not based on what you know, essentially. So yeah, in terms of technicals, because ideally the euro wouldn't really remain on the stronger side, at least in my opinion. Euro AUD, what I want you to note here, what we spoke about on Tuesday's breakdown, was watching the S&P and just gauging how does the S&P drive the AUD, and of course, as a result, Euro AUD. So we saw here a big old sell-off. Obviously, this is pre-market, so it hasn't opened. So if we have a little look at the futures then, S&P mini futures, they're actually taking it more on the weaker side there. And then if you look at Euro AUD on the side as well, Euro AUD, FXCM, let's zoom in, and you can kind of see like it is driving the AUD, where over recent period anyway, we have seen a bit of weakness in the S&P, but a bit of strength in the Euro AUD. So what you have to now think about is how much more downside can the S&P go before we eventually go higher, and that could allow you to understand, does Euro AUD rally or does it continue to come a little bit lower as the S&P rises again? I would be more on the what's the word I'm looking for, on the fence of it will probably continue to rise a little bit further on the S&P, and therefore Euro AUD can come a little bit lower over the near term, i.e. AUD strength because of S&P rising. So as a result of that, where would our regions of interest of selling be? That's what we're thinking here. Well, initially you can see on the daily, we have this supply zone here, and then that also lines up with a 12-hour. So basically what I'll be thinking is anywhere in that zone, I'll be looking for technicals, structure to start to turn bearish. So if we just go on the 4-hour, so basically like this, it can go higher or low. It doesn't really matter as long as we start to see some break of structures or some selling pressure that would suggest it, then we can start to get in. Anywhere even there looks good. So we're very close to it. Let's just see. EuroCAD, obviously EuroCAD has pumped today because of dollar weakness, but what this does give us a good guidance on is the Canadian dollar is literally being driven by the US dollar on the crosses. So the dollar strengthened this week, i.e. EuroCAD sold off. NFP came in really, really weak. And then of course the revisions, EuroCAD has pumped. So that gives you a good guidance of what's driving EuroCAD. So we have driven through 159, which was that region we were watching. So the next region then could be around this supply zone here. But like I said, when Drew is talking on the other currencies, I'll have a little look at what the main reasons why NFP was so weak. And then that could give us a guidance on, is this just going to be a volatility and then you're going to see some pretty crazy wick? Or is it something that can continue further or not? Euro GBP, I mean, we have basically come toward this low around 86. We don't have to exactly tap onto it. We have come toward that low and we have struggled to go lower, which is important. Now, where can Euro GBP go from here? Like I said on Tuesday, I don't think that the downside should cap up. I don't think it'll be too much downside. What I'm thinking more is a bit of euro weakness because it's new news, and then consolidation because euro is weak and so is the pound. So in that environment, you obviously don't trade it because you want divergence, but that would also entail, because euro's news is more new, people want to price it in, but then eventually consolidate it. So that's what I'm thinking more for Euro GBP. So possibly a little bit more downside. and then eventually consolidation, and then we can get into some more longs at some point in time. Euro New Zealand, we are approaching a 6-hour supply zone, but like I said, we want to see the technicals reverse from this region, and then we'll start to get in. If not, and you just breezes through it, we leave it alone. And next zone you could watch is here on this on the 6-hour. And lastly, euro dollar, that is quite an aggressive move actually. So we've moved from 114 to 154, so 154 pips move in 1 hour. That tells you the velocity of the move, and it tells you the substantial, how strong this print is and what it means. What it basically tells us is that this could entail more rate cuts being priced in, as you can see here now that we've refreshed it. So markets have gone back to pricing in a September cut for the dollar. That could allow dollar then to come a little bit lower initially, possibly more lower. Let's see. But yeah, that will then just entail euro dollar goes back towards sort of 117, 117, 500, 118. And therefore euro CAD, some of these trades are obviously driven by dollar. So if that's the case, then euro CAD will then go back higher above the supply zone. This supply zone will get breached through, because you have to think about what the drivers are. That would be the driver. So either one of these, we'll see how the dollar plays. Either it comes a little bit stronger, but initially based on what we've seen on the reaction function, and of course on sort of the data as well, it doesn't really entail the dollar can go a bit stronger now. We have moved quite aggressively. It seems that this may be the top initially, but we'll speak about it in a bit more detail next week. But yeah, apart from that, that's myself on the euro. To summarize, realistically, yes, the euro is weaker because of tariffs. I think you have to play it correctly in which trade you want to choose euro weakness through. For example, if the dollar does continue to come lower through next week as well, because of what we've seen with today's data, because the data today that we've seen will drive the thinking for the Fed next month in September when the next meeting is. Yes, the Fed was hawkish, but people are waiting for today's data to see, does it tell markets that September is not going to happen? Today's data does kind of tell us that it will happen. NFP is like tier one. It's like the creme de la creme of data, shall we say. As a result, because we saw such big downside moves in this data, it could entail that we have seen a little bit of a bottom in euro dollar, a little bit of a bottom in euro CAD. So use that to your advantage for sure, because we have seen quite large pullbacks in those pairs. As a result, think about other ones out there like euro AUD and euro New Zealand as well. So that is myself on the euro. Let's move straight on to the AUD.
So the Australian dollar and the New Zealand dollar, guys and girls. Now, first of all, there's only been one real bit of data that is driving those antipodeans, and that's basically the inflationary set that we've had out of the Australian region, which has slightly slowed, and we're going to look into that. And we did get business confidence coming in slightly better, but nowhere near sort of consistently gaining confidence levels. Yes, it's up a lot since the sort of lows of May, and it's getting better. However, if you look at the sort of 3-year trajectory of this, we're nowhere near the above the 50 mark of, say, August, September, October of last year. And if we go to basically post-COVID levels, we are arguably at really elevated levels compared to the worst of COVID. However, what I will say is we're not above that 50 level, but we are slightly improving since May of this year, which is something to be acknowledged. Now, on top of that, we did have some RBA rhetoric and commentary. It didn't really do much for us, but retail sales bounced back relatively firm for Australia, just showing an uptick in consumption. So PPI coming in at 0.7 as well, a non-print if you ask me. So let's look at this very brief week that we've had. So Australian dollar to gain despite inflation undershoot. So why is the Australian dollar to gain according to this article? Now, the RBA rate cut is already in the price according to this article. They say about the inflation revision and expectations. Oh, sorry, not revision, the print. And then they say inflation is within target. RBA is likely to continue reducing monetary policy restrictiveness, including by cutting cash rate at its August meeting, says Westpac. However, the trimmed mean reading, which is the RBA's preferred core measure of inflation, was still elevated at 2.7%, even if it had cooled somewhat from 2.9 in the first quarter. For currency markets, there should be enough progress in the data to allow the RBA to extend its rate cutting cycle next month. On paper, this looks to be a set of developments that would weigh on the Australian dollar. However, the currency is trading with a robust tone at the time of writing, suggesting little negative impact. This is potentially because the market was effectively fully priced for a rate cut. So all they're saying here is, guys and girls, is that the drop off in inflation just basically cements the fact that we knew a cut was coming anyway, so it doesn't change the current pricing. Pricing is therefore unlikely to shift to 50 basis points, even if labor market conditions continue to decline and CPI softens more than anticipated. Analysts at Bank of America potentially see the potential for the RBA to adopt a more hawkish profile, basically saying they're getting towards the end of their neutral rate, or basically end of their cutting cycle. Rising housing market momentum, above average credit growth, rising job vacancies, and declining underemployment are all consistent with our view that policy is only marginally restrictive. Given the risk of a hawkish tilt, B of A thinks there is benefit of betting on the Aussie gains, which is interesting. Now, UBS, on the other hand, if we scroll down, where are we? Inflation cools, but activity recovers. So they're in the same sort of agreement here. And they say, we think an August RBA cut looks 100% done deal, which aligns with our view of 2 cuts this year and a final one in February, bringing the terminal rate to 3.1%. And I believe the ASX is in agreement with that. ASX is at 3.1% by year end, I believe. So this is your CMEs, right, of the Australian market. Yeah, 3.2. So by Feb 3.1. So yeah, that's in alignment with the market pricing. Now, UBS then go on to say that, more importantly, the RBA's preferred trimmed mean measure also eased. And they say, meanwhile, Australian retail sales spiked, building approvals accelerated, so more building, more construction, more debt being accumulated to go into that, and credit growth was solid. As such, we reiterate our view to go long AU at the current levels with a target of spot 70 over the next 6 to 12 months. Very nice, very summarized. And this basically, summarizes the whole discussion we just had. Now, only thing I have regarding the New Zealand dollar is the sliding risk for a boon for the New Zealand dollar, which is a funny old statement. But the New Zealand dollar can build on recent strength as global risk sentiment declines in the wake of a series of trade deals. CA, I can never pronounce it, Julian will correct me, Credit Agricole, a bespoke risk index, has slipped further into risk-seeking territory, according to the update from the banks. This is one of their frameworks that basically values when to go long, go short, take risk, don't take risk. The index slipped through July after a series of bilateral trade deals between the US and trading partners has bolstered market sentiment. Forrester says the New Zealand dollar stands out as a potential beneficiary in such an environment. The AUD and NZD have the strongest negative correlation with our risk index. The yen has the strongest positive correlation. Further declines in the market fears look set to continue, with market measures of implied volatility through the month of August showing limited events on the radar that can upset this lull. This can allow for risk-sensitive currencies with high yield, like the New Zealand dollar, to build on recent gains. Volatility measures show investors expect risk to pick up again in September, like it does every year. So all they're saying is the New Zealand dollar could potentially benefit from a higher yielding, lower sort of vol-based environment. Now, jumping into the technicals, so we really don't have much this week. However, next week, let's see what we have. We have unemployment rate for New Zealand next week. We have, if we jump down, balance of trade, huge print for Australia, forecast to come out very, very firm. And then we have some Chinese data above all else. So again, it's going to be a relatively quieter week. So technicals wise, Aussie CAD range band at the minute between the 89 and the 90 level. Not really something that I'm going to want to be trading here. Aussie Swissy, hands off this at the minute, although if you want to just gain some carry in that portfolio, it does look to be basically holding the 51.5 to the 52.5 range. So it's basically carry on. Aussie Yen, however, is pulling back now. The Yen is catching a bid, and Mark can maybe jump into this a bit more shortly, but the Yen is catching a bid due to yields falling in the US and the value of the bonds going up. And this is driving the increase in the valuation of the Bank of Japan's balance sheet. So this is what's driving that yen strength right now. Aussie NZD is pumping, however, so this gives you a sign of how the market's basically digesting that sort of data and digesting the divergence between the two. I do think 111 could be attainable on this. We'd have to see a break of the 110 level clean. AU pumping straight from that 64.250 level, following the data from the US. I wouldn't look to be getting long this just yet. I mean, we do have this area of daily here, if you want to have a look at that. And I would be aware that 66.250 is where shorts last came in. So 66 to 65, 750 be where I'd be watching. But this is our new range, in my opinion. Now, jumping to the New Zealand dollar side of things, NZD CAD, I would rather go and watch paint dry. NZD JPY, again, yen catching a bid on those yields falling. It'll be interesting to see, do we pull back into the 87.250? Do we take out a load of these wicks that basically generated that push to the 89 level? NZD Swiss, no real opinion on this, whereas NZD USD is pulling back now on that US data. It'll be interesting to see how it handles this daily here at the 59.5 handle, or do we go and trade lower and take out the May lows? That's going to be the basically one of two decisions now. Are we going to push through this, pull back and continue on a weaker dollar narrative, or will we respect the region and start to take out the liquidity that sits below? So that's the next question. So that's really us on the NZD and AUD, guys and girls. It's been a relatively muted week, no real update. The inflation just cements a cut coming that we knew was going to happen for the RBA. But if they do present a hawkish cut and they say they're towards the end of their cutting cycle, this may present some opportunity to to look at AUD as an economy that is bottoming out and heading into the next phase of recovery if the data supports this. So that's just on the NZD and AUD, guys. And we also show CAD.
So the Canadian dollar. With the NFP, we also saw some Canadian dollar. No, we didn't actually. Sorry, I was reading it wrong. Normally it comes in at the same time. So I'll quickly read through this one over here by UBS. There's not much on the Canadian dollar front, to be honest with you. As we spoke about, we did obviously have the Bank of Canada at the start, which I'll see if I can get some stuff up for us. But largely from what I saw is, if I just quickly share my screen, where is it? This one over here, if I can find it. There we go.
Anytime today.
Anytime, yeah. And Canadian dollar is this one. So let's have a little look at what the Bank of Canada said, because what we have to think about here is at the moment, over the last few days, anyway, at least, the CAD is largely being driven by the dollar. If you have a look at EuroCAD, that's a really good example of that. And you can see now on the 2 o'clock candle, euro is still rallying. So it's, yeah, people are getting into the fact that this would allow the Fed to cut, which as we saw, September pricing has now increased quite aggressively. Previously, at the start of the breakdown, it was a very likelihood of above 50% likelihood of a hold. Now we've gone to 70% likelihood of a cut for September, 76% now. So as a result, if you look at EuroCAD, you can see it's literally being driven by the dollar. So as a result, EuroCAD can initially go higher. Therefore, Canadian dollar can go lower. I don't think the Bank of Canada, I'll be honest with you, is a driver of the CAD at the moment. Now, the bank left interest rates at 2.75%, and its guidance confirmed the odds of further cuts were limited. This has effect of bolstering domestic short-term bond yields and the currency. I can understand that. If the central bank does start to hold for a longer period of time, that can support the CAD versus those who are looking to cut more. But there is a consensus to hold and proceed carefully. The market pricing shows the bank should start raising rates again in 2026. And CIBC says this supports the CAD moving higher, maybe not against specific currencies. Against the dollar, sure, I'd agree with that. So like dollar CAD goes lower. But despite this, the Canadian dollar is resisting US dollars advance better than most, meaning it's following its southern neighbor higher against its G10 peers. So that's the CAD stronger on the crosses narrative, which is what we've seen today. Presented below is our week ahead forecast made 2 weeks ago, which we opted to keep in situ this Monday. It shows our calls for a shallow mid-month rebound following a fall. That's on GCAD. Technical momentum is in favor of Canadian dollar, but now with GCAD has been knocked back, domestically, the interest rate outlook will increasingly matter as market attention shifts from trade wars to relative interest rates dynamics. A bullish CAD scenario would involve a prolonged pause at the Bank of Canada. And you'd understand, so essentially what you'd be thinking is, why would the Bank of Canada hold for a period of time? That's the question you're asking yourself. As you know, that will come from the data. So if the data holds okay, it doesn't need to substantially strengthen or substantially weaken. We just need it to hold steady. If it comes a little bit lower, that should be okay. But as long as it doesn't substantially move lower, if it does that, then obviously people would think more cuts are going to come. But if it's a gradual move lower and the Bank of Canada is towards their neutral rate, which I believe they are, that just means that there's less cuts expected, which could support the CAD. It doesn't seem like it is at this given point. But further rate cuts would be appropriate if it became clear that the economy would be sliding into a recession. So look at the unemployment rate. Barring such deterioration, following our base case, we expect the Bank of Canada to maintain rates going forward, says Claire at the RBC Capital, which you may have seen as. However, economists at Wells Fargo think there are more cuts to come, which, if correct, could upset current market thinking that the cycle is more or less done. Unless trade tensions escalate further, the Bank of Canada expects headline inflation to remain well contained, even if core inflation remains elevated. This is one reason, in our view, why the central bank maintains an overall bias of easing. So basically, inflation's holding pretty sticky. So to bring that sticky inflation lower, they're going to have to, as rates come lower and lower and lower, they're going to have to cut. I don't know why they're saying that, though. Reason, our view, why the central bank maintains overall easing is inflation remains well contained. They may be thinking about a growth perspective. But Wells Fargo thinks the Canadian economy will experience slower growth and deterioration in core over time. leaving for 50 more basis points of cuts. Okay, so that makes more sense now. If such an eventuality, market missile realignment would constrain the CAD's advance, potentially even reversing it. So CAD weakness, basically. Let me double check the inflation rate at the moment. So where is Canada? Here we go. Prices, core inflation rate. Okay, core is at 2.7%. So it's still above target because, as you know, central bank's target is around 2%. I believe the Bank of Canada's target, though, is between 2 and 3%, if I remember correctly. So it's still in its target band, but it's on the upper end of its target band. Yeah, it is also advancing, though. Okay, that's interesting. We'll have a little look at the other data in the weeks and sort of months ahead. Now, UBS mentions this, so they do talk a bit on the Bank of Canada as well. And they say they obviously less rates unchanged. Latest inflation prints exhibited a resurgence in the upper bound. Further, the economic data has held up better than expected. The latter remains a downside risk. So they're talking about the economic data being the latter. Better than expected in the face of US tariff threats. The latter remains the downside risks, and the related uncertainty also speaks to the BOC in a wait-and-see mode. The CAD slightly weakened in the immediate aftermath of the meeting, but this was largely driven by broader dollar move. In the medium to longer term, the US growth slows and the Fed cuts. We expect dollar to weaken against the CAD, and we see USD CAD. I would agree with that. Obviously, dollar CAD should go lower. Initially, I think Euro CAD could go higher over time, though, over time. Further, we think current levels of around 138 are attractive for investors with CAD-denominated portfolios to hedge USD exposure. So we were at 138. We're at 137.7 at the moment. So yeah, apart from that, there's not much else to add on to that. I would largely just follow what the dollar is doing for the near term, because if you just look across the board, GCAD has pumped, CAD JPY is obviously lower. Also, the yen is beneficiary of weaker dollar as well. AUD CAD has pumped. USD CAD is a little bit lower. We don't enter that because there's no bullish price action there, and there's no bullish price action here either. And Euro CAD as well. And NZD CAD has outperformed a little bit stronger. Yeah, for now, I would actually just follow mostly on the dollar. That seems to be the most immediate term driver until eventually it doesn't. And you'll know if it then eventually doesn't scenario when the dollar weakens further, but CAD doesn't move, or if the dollar strengthens, the CAD doesn't strengthen. That's when people are, okay, then you think, what is the driver of the CAD at that point? But for now, the dollar is the driver. So that's all we're thinking about for the time being. Until it changes, we'll know if it changes, because we'll sort of speak about it in the breakdowns. But yeah, apart from that, it's myself on the CAD. I haven't got much technicals. I would be more focused on like Euro CAD, GCAD, dollar CAD for now, which we've already spoken about. So to summarize on the Canadian dollar, as we spoke about throughout the breakdown, pretty much follow the dollar. That is the main driver. So if based on what we've seen today on NFP, considering that's like the top data alongside, of course, inflation, but because NFP is coming quite substantially lower, and the revisions, because that's important, the revisions as well, not just the headline you see on the news, the revisions from the previous months being revised quite aggressively lower, that would entail a bit of weaker CAD across the board on the crosses. So like Euro CAD could go higher, GCAD could possibly go higher. CAD JPY, we spoke about how elevated that was on Tuesday. That could come lower as well. So there are a few opportunities there now bubbling for you. We just have to wait for the pullbacks because obviously we're not entering on the news.
Bit of a sidebar conversation though, but it's always the US revising, isn't it?
True.
So when do you hear New Zealand revise their unemployment rate, or when do you hear like they've miscalculated their COF data?
I guess that's true. Yeah,
bit sus, isn't it?
True. It's a little bit sus. I think they need to get better ways of finding that data. I'll be honest with you.
Well, I'll take a director role at Goldman. You take what's the ONS version of who collects the data actually?
For the US is
you've got the
Bureau of BLS.
That's it, yeah.
The Bureau of Labor Statistics.
Obviously, it's ISM for like the sectors, and then
yeah. But like BLS is the main, like the ONS version.
How about you get a job there? I'll get a job at like Goldman. We can.
Fair enough. All right. I guess I'll have to get a US citizenship then in order to get there.
A Cayman's account, a Luxembourg, Geneva account.
Pretty much. So yeah, apart from that, I pretty much just followed the dollar. That is the main driver. And based on what we've seen today, the dollar should weaken off a bit further. Therefore, the other trade should go higher on the crosses against the CAD. So that is us on the CAD. Let's move straight on to the yen and the Swiss. So the yen and the Swiss, as you know, we had the BOJ at a BOJ meeting. They held rates as largely expected, but what we are obviously more focused on is what they have said. So let's quickly have a little look at as to what they did mention, and then we'll sort of gauge it from that. Based on obviously today, the yen is still also following what yields are doing, and we have obviously seen quite a move lower in the yields. The yen has also strengthened, so that is also a driver of the yen that we need to consider. But for now, the BOJ, this is what they say, or this is what they said. As widely expected, the BOJ unanimously kept its rates at 0.5%, a way to emphasize the data-dependent nature of policy, but notable upward revision to inflation outlook increases the likelihood of a rate hike in October. So that's a good sign. Now, despite the US-Japan trade agreement, the BOJ will need to take time to evaluate its impact on growth and inflation before adjusting its policy rate, especially given fiscal uncertainty. So obviously the fiscal policy uncertainty is what the government wants to do with their spending. Thus, today's pause came as no surprise. In our view, the BOJ has eased its concerns about trade uncertainty and will now focus on the inflation mandate instead of risk management. Let me double check. Do we have inflation next week from the BOJ or from Japan? Sorry. We have average cash earnings, so that will be very important. That's wages. So as long as wages stay pretty good, according to the forecasts, it is. That should support the idea of an October rate hike. We haven't really got much else here. And then the week after next, nope. Week after that, then we start to have inflation. So towards the end of August, we have the national core CPI. Jackson Hole as well, happens every summer, is also very important. That's when the Powell will start to talk, etc. And that will drive the yen as well. But from a data perspective, the main bits of data is mostly going to come from the end of August. So what we have to think now is what's going to be driver between now and then. It's going to be the US. So dollar yen, as you can see, has come lower. If we get up yields, where did this come out? 1.61750, 105.750, it seems. Yeah, 107.5, 150.75. If I get up the yields as well, you'll see the correlation. The US, have I got it on here? I haven't. US 10-year yield versus Japanese 10-year. And you can see, obviously, it's not going to follow it to an exact degree, but we saw a bit of divergence here where the spread should technically suggest dollar yen should go lower. But initially today, we see that it has now started to reconnect. That doesn't mean now you need to target 140. But what it does mean is that we could start to see some sort of adjustment with yields. Hopefully, fingers crossed, because that would mean a lot of downside. Adding on to that, uncertainty surrounding domestic politics should be closely watched. With LDP and Komeito coalition recently losing the election, there has been growing concerns over Japan's fiscal. For now, Ishiba remains in office, so immediate concerns seem to have been contained, but we expect the cash transfer program to be executed. This would boost private consumption. However, eventually Ishiba will resign, and there should be more policy coordination required with opposition parties. As opposition parties advocated for tax cuts, this will keep JGBs under pressure. So that's something we'd need to consider when it becomes a bit more of a problem. Right now, they say it's early days, like Ishiba is still in office, so it should be contained. But when it does eventually come into pass, or like when it does eventually become more prevalent, that could create a bit of yen volatility. But for now, like I said, let's mostly follow the dollar because that is essentially what it is following. So if we continue to see, let me just double check if we have anything major next week for the US. ISM services, of course, will be very important. Watch the employment figure for that. We'll obviously speak about it on Tuesday anyway, but just quickly monitor I'll show you what you need to watch. This one here, based on what we saw today. So if we see, you can see June was at 47.2, so it's in contraction. We see another big drop there. People will now start to think employment is going to drive lower. Fed then needs to start cutting more, and therefore it becomes more prevalent that growth is slowing, which it has been, but we have seen quite a big pickup over the past few months now, based on what we saw with revisions. But yeah, apart from that, Drew, that's myself on the yen. I do think we probably could strengthen a bit more now, based on what we've seen with inflation. A lot of this, like dollar strength, was largely driven by the like the 101s, 103s, was driven by mostly NFP holding pretty well on the data. But based on what we've seen today, we seem to have created a top in the dollar at this point in time. And therefore, a top in dollar yen, and then hopefully, fingers crossed, the yen can start to rally. But yeah, that's myself on the yen, Drew.
Not bad, Mark. Not bad.
Thank you.
What I would add to Mark's thesis is obviously if the data continues to roll out in favor of dollar weakness, i.e., let's say we start to see inflation ease in August, we start to see, data continuously missed to suggest that potentially we do get 2 cuts this year as opposed to 1. The further the 2s fall in the US and the further the yields fall corresponding to the rising of the bond value in the US will also basically net out and equate to the value of the balance sheet of the Bank of Japan increasing. Now, when you couple that with the fact that you have a hawkish BOJ and a dovish Fed, potentially, if the Fed have to take that path, if the data deteriorates, yada, 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 that may materialize into a diverging narrative that would favor dollar yen downside, which was basically the sort of start of this year's thesis when we were targeting 140, 138. But except this time we've got way more discounts, sort of 150s. So yeah, just keep an eye on that. Now, Swissy-wise, there's only one thing, and if you haven't heard about it, you've been living under a big old boulder, and it is the tariffs from Trump. So Switzerland slammed with 39% tariffs rates in US trade blitz. Donald Trump will impose 39% tariffs on imports from Switzerland, one of the steepest levies globally, which threatened to leave the country's key exports reeling. The outcome, detailed in an executive order on Thursday, is higher than the 31% tariff Trump had threatened to levy in April, and dashes hopes that the country would secure a more favorable deal. The Swiss government expressed its great regret, pointing out the new tariff rate differs significantly from a draft framework the country has been negotiating. Bern's trade negotiation were caught unawares by the announcement, since they had received encouraging signals from several senior US officials, according to a person familiar with the thinking. So apparently they were talking, there was development, they were making some progression, but it fell out of bed. And Trump said, you know what, F you, and he's just slammed it on them. What I will say is Trump he's the type of guy that will take, if Switzerland can come back to the table and they want to make a better deal, will he just rule them out? Probably not. There could be more renegotiations, but for now, that is your rate. Now, President and Finance Minister Karine Keller-Sutter said she had a final conversation with Trump before the deadline, and the trade deficit remains at the center of the US concerns. The Swiss government said it continues to seek negotiation solutions. So what I would say is that it's potentially an ongoing thing, but this is the rate as it's set for now. The franc was among the worst performers on the announcement, to no surprise. For Swiss chocolatiers, including Lindt, and watchmakers like Swatch Group and Rolex, the steeper levies threatened to weigh on sales in the world's largest consumer market. Pharmaceutical accounted for almost half of Swiss goods exports to America in 2024, according to the Bloomberg. The Swiss economy rests on large contributions from industrial giants like Novartis, I can never pronounce that, Novartis, and Roche. Drug makers face a double squeeze as Trump escalates his campaign to pressure them for lower prices, sending letters to 17 of the world's largest pharma companies demanding they charge the US what other countries pay for new medicines. Now, Bloomberg said the 7-day window for the new tariff to be implemented provides time for additional negotiations. So basically between the 1st and 7th of August, there may be a new deal made. For those interested in reducing reciprocal or sectoral tariffs, Switzerland, India, Taiwan might still be working on those talks. But it is forecasted that the US had a 38 billion trade deficit with Switzerland last year, just outside ranking of the top 10 trade shortfall. So Trump wants to improve that. Switzerland might not have been able to offer the US concessions other countries were able to provide. It already unilaterally scrapped industrial tariffs, suggesting lower import rates for American citrus fruits, nuts, and shellfish. So all I'd say is the summary on the Swiss mark is that, look, they've been slapped with the tariff, but it goes into effect on the 7th of August. We've got 6 days from today to make this happen. So I would not be surprised for a new trade deal to come out. And again, it probably would favor the US because the Swiss are probably stuttering now, and how do we get a better route of this? What I will say is the Swiss franc remains as usual. You levy into it in a risk-off market because of the ZERP interest rate that currently has zero interest rate policy. It's in a ZERP narrative or ZERP market. You levy into it in a risk-off market in big times of turmoil, and the market's going to carry against it during low vol like August and risk-on market. So what I would say is if there isn't a deal made between now and the 7th of August and we do go into a lower volume market, the market may snap up bargains against the Swiss franc to basically achieve that carry yield in a lower transactional based August, which would benefit high yielding currencies against the Swiss franc, especially those that have lower tariff deals. So something like pound Swissy, euro Swissy, arguably Aussie Swissy, something along those lines. Especially if the RBA hold hawkishly, Aussie Swissy would be a great bet, not financial advice, a great thought process, let's just say. Yep. So that is us on the yen and the Swissy, unless you have anything to summarize on the yen, Mark.
No, literally just follow the dollar, and based on what we've seen today, obviously it just it's quite interesting what we saw today, actually, not this week, where dollar strengthened because people are like, oh, the Fed's going to be hawkish. Perfect. We saw that. Dollar then rallied. They were like, oh, labor market should remain relatively okay. And then today just done a complete U-turn. Like it seems as if Powell just didn't know what NFP was going to do today. So it's quite interesting that we saw that completely U-turn. It basically gives just doubt on what everything happened this week. So we
Twos are still melting as well. Twos are taking a dump.
Yeah. So like the whole thesis of like the dollar, etc., just seems to be thrown on its head, really, just based on today's NFP. But yeah, apart from that, just follow the dollar for the yen at the moment. That is us on the yen and the Swiss. Let's move straight on to gold.
So finally, to summarize this beautiful breakdown, we have gold. Now, we're going to actually touch on gold and silver today. Now, I've got one article here from Fidelity, and I'm just going to read the bullet points from them. I'm not going to read through the whole article. Fidelity says 4,000 is on the cards as Fed cuts, and we're starting to see the data lean into cuts, right? Gold could hit 4,000 an ounce by the end of the year, according to Fidelity, as the Federal Reserve cut rates and the central bank keeps adding holdings. Fidelity International Ian Sampson said the firm remains bullish on gold, citing a clear path to more dovish Fed and the potential for a softer dollar. Sampson said gold's appeal as hard assets will continue to be reinforced by growing fiscal deficits, and that's just not just in the US, that's globally. And the metal is not necessarily overstretched in the context of a bull run, according to his opinion. The rationale for that was that we saw a clearer path to a dovish Fed. He goes on to say gold is up by more than a quarter this year as uncertainty around President Trump's aggressive attempts to reshape global trade, conflicts in the Middle East and Ukraine, central bank accumulation, buttressed gains, I can't pronounce that, buttressed gains. But still, the metal has traded within a tight range over the past few months. Perhaps you're going to avoid a doomsday scenario that we painted earlier in the year, but ultimately we're heading to a 15% or 15% or so tax on about 11% of the US economy, which is imports. You'd expect it to slow the economy, which I think is true. That's why Fidelity holds a bullish view and they see 4,000 as an attainable target, which is, it makes sense. They say that US slowdown will likely see dovish camp gain more influence in policy. Non-yielding bullion typically benefits on a weaker dollar, and other central banks globally are likely to continue to be buying gold while the fiscal deficits rise globally. Sure, gold has come a long way, but if you look at when gold's been in a bull market like 2001, 2011, it annualized about 20% a year. From 2021 today, it is also annualizing 20% a year. So it's not necessarily, in the context of a bull run, massively overstretched, which is true. Now, UBS on the silver side of things, because they did not mention gold, I do not believe. I did have a little scan. Let me just do this. Gold. That's on. Okay, selling downside in dollar. However, we believe the recent moderation in trade tension could easily reverse as, okay, you're wrong. Fiscal cancer issues. This supports our view that investors' interest in gold will remain strong. As such, we regard a pullback as opportunity for yield pickup strategies. I agree. In other words, as yields fall, bond prices rise, etc. In other words, we like selling the downside in the pair below 3,180 over a 1 month period. In other words, okay, they're soaking that up. Let me just do this. Gold. Okay, then silver. So silver has been one of the best performing metals this year, surging 32%. Other precious metals have also posted strong gains, with platinum, palladium, and gold at 53%, 38%, and 27% respectively in 2025. Strong ETF inflows, a weaker US dollar, and tariff threats on the US metal imports has provided the right conditions for silver to catch up and to eventually outperform gold year to date. We expect silver prices to rally further, likely reaching 42 ounce in the coming quarters, driven by strong investment demand as the Fed cuts rates. A similar view is Fidelity. Since 2021, silver's faced structural deficits, resulting in cumulative shortfall estimates about 796 million ounces through the year, supporting our positive forecast. So basically, there is more demand than supply. And we reiterate our preference to stay long silver. We view price pullbacks as buying opportunities. We also continue to favor to selling downside risk in silver for yield enhancement. So basically what they mean is that they are net long, but they will also trade the pullbacks because you get paid to sell this metal in terms of swaps. Now, I did have this area pointed out for silver. My 2 points of interest remain the 36 level, or the 36.5 was where I was looking at. Now, we've basically bounced to 36,250 as we run that low. Arguably a bit of liquidity there, but I'm not going to deep it too much. It's irrelevant either way. So what I'll be looking for now is more of a lower time frame potential showing of something. So we've got this 4 hour supply that we're reacting out of right now. But if we trade above here and pull back, I'll look for a lower time frame. 36,750 is something for potential uprun. And with regards to gold, obviously we've caught a great position on this. We traded out of this 4 hour area demand, 32.70. What I'll be looking for now is essentially, do we hold this level or do we pull back? Now, if we pull back, we have a lovely area to be of interest in here. Not my favorite one, but Mark did point this out and I said, fair enough, sell to buy. So I'll mark it as we're here. And this would be something that we would look at as more of a 3,300 level, key level in here. If we get a pullback to something like this, I would be looking for some sort of entry model and potentially push this back into the daily supply at the 3,400 that I will chart out for you. Now, half the time I have the supply in my head, I just don't draw it out. I need to be more attentive with my chart. So this would be a sort of play. It would be 1,000 pip move, 3,300 into 3,400. That's my next likely point of interest. If I'm not tagged in and around here, we do not get a pullback because we are now taking out some lower time frame highs, as you can see, some liquidity, and we, starting the month off. So if you want to accumulate sort of early positioning for the month, now is your time to skim some profits, pull back and fill your boots. So what I'd be looking at is that 1,000 pip run. If we don't get that pullback and this level doesn't hold, as I said in previous breakdowns, 3,225 would be what I'd be looking at then. So these are the two levels, 3,300 or 3,225 would be my points of interest, but I don't think we have legs to get down to 3,225 anytime soon. So this would be my next point of interest with a simple range bound move. Because if you look at it, essentially this is our range on gold, basically here and here. This is our range. So this is what we call cheap gold. This is what we call expensive gold in the current market pricing. Now this was cheap as reflected in the current pricing and the macro update that pushed it. This would then be, of course, another cheap region, and this would then become slightly expensive again once we get to the top of the range. So for me, I'm looking at that 3,300 into the 3,400, and that, Mr. Fraser, is the summary of gold. Never financial advice, is it, Mark?
Never.
It's not from me anyway. It might be from you, but it's not from me.
Definitely not from me, no.
Definitely not from you, okay. Well, that is us on today's breakdown. We hope you enjoyed the educational resources that we provide. We will be seeing you next week on what date will that be? 2nd, 3rd, 4th, from the 5th of August.
Yeah.
And yeah, we hope you enjoyed today's breakdown. Anything you need, please do reach out. We're there in the Discord. We have our outlooks in there, our analysis in there. We update you every day on the dollar, the pound, the euro, the Aussie, the CAD, New Zealand yen, Swissy, China, gold, commodities, risk events, emergence. We have it there. The bank research docs, leverage them, understand what MUFG, what everybody's saying, pick up on views, ING, whatever, and accumulate your own bias. Always fundamentals first, and then once you understand strong versus weak, the sentiment warrant that positioning, then you execute through the technical avenue. So that is us on the breakdown today. We appreciate you tuning in, guys and girls. Have a great weekend, and we'll see you next week. Take care.
Take care.